2025 was a strong year for global markets. Stocks climbed roughly 16% worldwide. The big question now is simple. Can this rally survive into 2026, or is a cool down coming? So far, the baseline outlook suggests the economy continues to grow. Major institutions still expect positive GDP growth. This picture is shaped by heavy investment in AI, supply expansion in China, and slowing growth in Europe. But growth doesn't come without risks.
China says it has started large-scale military exercises around Taiwan.
The standoff with Venezuela has taken a sharper turn.
Canada just dropped a $1 trillion economic bombshell.
So we're spending 40% more money than we're taking in.
Trade protectionism is back in focus, with higher tariffs and rising geopolitical tensions. Debt is becoming more expensive as refinancing occurs at higher interest rates. Energy prices remain vulnerable due to global conflicts. And AI carries risks, from a potential capex bubble to large-scale job displacement. Together, these pressures test the resilience of both the economy and the financial markets. So how much damage could they really do? We got a sneak preview in early 2025 when markets dipped after the new US tariffs were announced. The panic didn't last long. Investors quickly concluded that sky-high tariffs weren't unlikely to persist. Today, US tariffs range from 10 to 50%, averaging about 17%. Markets are betting that this number declines as political leadership changes or existing policies are ruled unlawful. But if tariffs rise instead, markets will take notice. Historically, a meaningful tariff increase has led to 7 to 10% equity declines over 2 years. Moreover, if tariffs drive inflation, the Fed may need to stay restrictive. And at the same time, tariffs could push China towards deflation and squeeze corporate profits. When debt servicing costs begins to extend profits, recessions tend to follow. Higher interest rates are already biting. Companies have held up so far, but cheap 2020 debt is rolling off, and refinancing is becoming costly. Historically, rising interest expense don't trigger recession immediately. For now, markets believe this is manageable. Governments aren't immune either. With debt level near record highs, interest payments consume a growing share of budgets.
We're operating at a fiscal deficit now that is unsustainable. You know that if something can't go on forever, it will end.
History suggests that major debt crises usually need a trigger. That catalyst could be geopolitics. Oil has often been one. The IEA still expects a record surplus, which could keep prices around $50 to $60 if conflicts remain contained. But tensions in Venezuela, unresolved wars in Ukraine and Gaza, and Europe's push to phase out Russian energy all leave supply fragile. The largest risk lies in Taiwan. Any escalation there could trigger a silicon blockade, freezing the global tech economy. TSMC produces roughly 90% of the world's most advanced chips. Models suggest such a shock could cause an immediate 34% market drop faster than COVID. In that scenario, the AI boom would unwind overnight. Even without geopolitical shock, AI still carries downside risks. If revenues fail to justify the massive capital spending, it is already enough to trigger a 15 to 20% correction on its own. The labor impact is harder to gauge. Goldman estimates AI could displace up to 7% of US jobs. Unemployment is already drifting upwards, now around 4.6%. So where does that leave us? The base case for 2026 remains moderate global growth, but the momentum from 2025 could face meaningful headwinds. The estimated downside risks are An AI-driven job displacement or an energy supply shock, expanded trade tariffs, an AI capex bubble bursting, debt refinancing triggering a recession, a Taiwan silicon blockade. In this environment, adding bonds could also help. Yields are finally attractive again and can provide dry powder when markets correct. Thank you for watching. If you found this content interesting, consider liking the video. If you have suggestions, feel free to leave a comment. And if you want to stay informed, don't forget to subscribe.